Every World War II tank has something much more important: money, factories, labor, industrial productivity, and inflation. Every machine rolling off an assembly line represented a financial decision. Which nation invested its capital better during World War II? The answer contains a lesson every investor should understand. Let's start with Germany. The most expensive vehicle produced was the Tiger II heavy tank, costing approximately $320,000 in 1935 US dollars. Adjusted for today's money, that's several million dollars. Every single King Tiger tank represented a massive investment of steel, skilled labor, machine tools, and of course fuel. The Tiger I wasn't much cheaper at around $120,000. The Panther came in near $60,000. The Panzer IV around $46,000, and even the relatively simple StuG III assault gun cost roughly $33,000. So Germany wasn't simply producing machines. It was building an increasingly expensive portfolio of industrial assets. Each new design demanded more specialized manufacturing, more machining, more engineering hours, and every improvement pushed production cost even higher. That is exactly what investors call overcapitalization. More money was being invested into fewer assets. Cost alone tells only half of the story. Output reveals whether those investments generated returns. Germany built approximately 6,000 Panthers, 5,700 Panther IIIs, 8,800 Panzer IVs, and 9,400 StuG IIIs. Sounds impressive until you notice something else. Only 1,347 Tiger Is and 492 Tiger IIs. Less than 500. Imagine spending enormous capital on a production line that ultimately delivers fewer than 500 finished products. From an economist's perspective, that's terrible economies of scale. High fixed costs, limited production, very poor return on industrial investment. Now, compare that with the United States. The famous M4 Sherman cost approximately $46,000. Almost 7 Shermans could be built for one Tiger II. Imagine you are managing a $1 billion investment fund. Would you rather own one luxury asset or 7 productive assets? Most investors already know the answer. Diversification usually beats concentration. The American economy followed exactly that logic. Instead of maximizing individual performance, it maximized industrial efficiency. Factories became standardized. Parts became interchangeable. Workers repeated the same processes thousands of times. Learning curves reduced costs. Mass production increased productivity. Capital expenditures were spread across enormous production runs. The result? Lower average costs, higher output, and better returns on investment. The Soviet Union followed a surprisingly similar financial philosophy. The T-34 cost approximately $31,000, even cheaper than Germany's Panzer IV. Again, lower unit costs meant more production. Standardization reduced complexity. Simplified manufacturing reduced labor hours. Factories could keep producing despite shortages. In finance, simplicity often wins. The same reason index funds outperform many actively managed portfolios. Less complexity, lower costs, higher consistency. Industrial economics followed exactly the same principle. But here's where the economics become even more interesting. The purchase price isn't the real cost. Ownership is. Modern investors understand total cost of ownership. Buying a Ferrari isn't expensive because of the purchase price. It's expensive because of insurance, maintenance, fuel, and repairs. Exactly the same principle applied during the war. More sophisticated vehicles required more spare parts, more mechanics, more transportation, more fuel, longer repair times. Suddenly, the real lifetime investment became far larger than the sticker price. Finance people call this hidden liabilities. They don't appear immediately, but eventually they dominate the balance sheet. As the war continued, inflationary pressures increased across Europe. Commodity shortages worsened. Steel became harder to obtain. Fuel supplies tightened. Transportation networks deteriorated. Germany increasingly fell into what investors call the sunk cost fallacy. After investing heavily into sophisticated production, changing direction became politically and economically difficult. Instead of simplifying manufacturing, resources continued flowing into increasingly expensive projects. Businesses make this mistake constantly. We have already invested too much to stop. But markets don't reward past investments. They reward future returns. The same rule applies to economies. World War II tank production demonstrated something investors continue learning today. Efficiency often beats perfection. Cash flow beats prestige. Scale beats complexity. And the best investment isn't always the most impressive one, because history isn't usually won by whoever spends the most. It is won by whoever allocates capital the smartest. That's a lesson every investor, every business owner, and every government should remember. I hope you enjoyed this video. To make sure you don't miss my future work, subscribe to my channel and press the bell notification button. Thank you for watching and see you in the next video.